Office supplies may not sound like a 21st century business, but Office Depot looks like an interesting stock right now. I'm Jack Otter, editor of Barron's.com. I'm here with Jack Howe, a senior editor at Barron's Magazine. So Jack, I don't know about you, but it's been a long time since I went out to buy a stapler.
Yeah.
But Office Depot is a $5 stock that's up today on a Barron's story by Jack Willoughby that says it's just a little bit too underpriced.
It's not an easy business to muster excitement over a great year, but sometimes that's how value stocks are created. And this is a business that's been slow for a long time. You had that big merger between Office Max and Office Depot, and that creates some opportunities to cut costs. You've got some store overlap, opportunities to bring down corporate overhead. They have someone, leading the company now who's kind of a turnaround specialist. So
a West Point grad, so he's whipping things into shape.
Right. And the stock obviously looks very cheap right now. I think it was under 3 times EBITDA, which is real cheap for a retailer. So. Good opportunity for earnings growth. You're coming off a low base. You really could see some rapid earnings growth. Whether there could be a takeover in the future, I don't know, because there are so few rivals now. Who is there? There's just Staples. So you can say, well, regulators.
The real competition is coming online.
They might argue that the online competitors like Newegg and Amazon, that provides enough competition. So we'll see going forward. But the stock does look cheap.
Another stock that's up today on a Barron's story is Boise Cascade. I think that people.
Speaking of businesses, it's hard to get excited about. We moved from office supplies to lumber.
Yeah, exactly. And I think that people forget how much the overbuilding in the housing bubble led to this problem where we just had more houses than we needed. Nobody needed to bang nails anymore because we'd already built them.
Well, housing, it seems to me, a lot like the stock market right now. It keeps moving higher, and yet people have not enough of their money in stocks. And in housing, it's the prices have really rebounded. There's a lot of transactions. Builders are reluctant to build because they don't quite trust the recovery yet. And when you see that pickup in building, that's when it could really boost earnings for the companies that are making these materials, lumber companies especially, like Boise Cascade.
Construction is still well below its pre-crash levels.
Right.
On the negative side, in the Trader this week, Vito Racanelli wrote about Valeant, a stock that just keeps on going up on takeover speculation. There's this battle raging with Allergen. But really, I think it's been one of those stocks that's kind of been a coin flip. If it gets taken over at a high price, it's a great investment. But if not, does it deserve this valuation?
Well, I like Vito's argument a lot here. What he's saying is everybody's looking at the adjusted earnings on this company, and what are earnings adjusted for? Well, past acquisitions. Their earnings are made to look better. But Valeant is a company that's really in the business of acquisitions. It doesn't do a lot of research on its own. It goes out and it buys companies that have already done the research. So if it's in the acquisition business, should we be looking at a measure of earnings that don't include all the charges that stem from acquisitions? He argues no, and when you look at it relative to another measure like GAAP earnings or free cash flow, suddenly the analysis does not look as favorable for Valeant. It looks like it could be pretty pricey, and it has taken on a lot of debt.
And shares were down about 1%. Now, granted, the market's not too keen on healthcare today with the Merck and the Gilead news, but still it's down much more than the market. Thank you, Jack.
Thanks.